Hi, welcome back to the channel. In today's episode, I want to talk to you about what's happening with the US dollar because over the past few days, the dollar has come under increasing pressure and has fallen against a number of major currencies and has dropped to its weakest level against the euro for around 3 months. And this has happened at exactly the same time that the US government has started taking action to try to bring long-term bond yields back under control. And that's raised a very interesting question. Could the United States eventually start experiencing a milder version of something we've already seen happening in Japan? Now, I'm not suggesting that the US dollar is about to collapse like the Japanese yen has done. We're a long way away from that. The dollar remains the world's dominant currency, and the United States is in a very different economic position to Japan. But some investors are now starting to draw a comparison because Japan has spent years dealing with an enormous government debt burden. It kept interest rates extremely low, its central bank intervened heavily in the government bond market to prevent borrowing costs rising too far, and one of the major consequences was enormous downward pressure on the Japanese yen. The currency effectively became part of the adjustment, and that raises a fascinating question about the USA. The States now has more than $40 trillion of government debt. Investors have been demanding increasingly high returns to hold long-term US government bonds. The 30-year Treasury yield recently climbed above 5.3%, and the US Treasury has now stepped in, increasing its purchases of longer-dated bonds and potentially shifting more government borrowing towards shorter maturities. Initially, that brought down long-term yields, but the effect didn't last very long, and at exactly the same time, the US dollar weakened. So the question increasingly being asked is, if Washington doesn't want the adjustment to happen through much higher bond yields, could some of that adjustment eventually happen through a weaker dollar instead? And that's where another phrase has suddenly started appearing in financial market discussions: dollar debasement. Now, if you've never heard that phrase before, don't worry, I'm going to get into exactly what it means later in the video. But essentially, there is now a debate about whether the enormous US debt burden could eventually result in the value of the dollar being gradually eroded over time. And we're going to come back to that in much more detail later in the video because I think it's potentially the most important part of this entire story. But the interesting thing is that we're already seeing some market movements that fit into that debate. The Treasury has stepped into the bond market, the dollar has weakened, gold has jumped, Bitcoin's also gone higher, and investors are starting to ask whether the pressure we've been watching build in the US bond market might simply now be moving into the currency market. And this is where the comparison with Japan becomes really interesting. Not because the US is the new Japan, it isn't, and not because the dollar is about to experience the same sort of collapse that we've seen with the yen, but because the underlying dilemma has a lot of similarities. When a heavily indebted government wants to keep the cost of servicing that debt under control, something eventually has to give. Either investors receive higher returns, the debt has to be reduced, inflation reduces its real value, or the currency absorbs some of the pressure. So in today's episode, we're going to look at what's happening to the US dollar, why investors are starting to make these comparisons with the Japanese yen, what this increasingly discussed idea of dollar debasement actually means, and whether America's enormous debt burden could ultimately force policymakers to choose between higher interest rates and a weaker currency. Because if that choice really is starting to emerge, then what we're seeing right now could be significantly more important than a simple 3-month move in the dollar index. Now, before we get into all of the details on all of this, if you're enjoying my videos, could you please give this one a thumbs up? Please subscribe to the channel. Please hit that red subscribe button if you haven't done so already. And if you have the option, if you see that weird looking hype button, which sits alongside from the thumbs up, then that will basically boost this video. It will promote it with the algorithm and more people will get to see it. So if you could hit that hype button, that would be fantastic. So let's start with what's been happening to the US dollar. Over the past 3 months, the US dollar index has been moving lower. Remember, the dollar index measures the dollar against a basket of major currencies. There's 6 of them. So this isn't simply the dollar falling against one currency, we're seeing broader pressure. Following the announcement that the US Treasury was going to double the size of some of its long-term bond buybacks, the dollar index suffered a particularly sharp fall. The euro strengthened, as did the pound. Gold surged in price. And by the end of the week, the dollar was close to its lowest level against the euro for 3 months. Now, one week's currency movement doesn't make a crisis. Currencies move around all the time. But the timing is what makes this particularly interesting, because the dollar didn't suddenly weaken because the American economy collapsed. It didn't weaken because the Fed cut interest rates dramatically. Instead, the move came as the government attempted to relieve pressure in the bond market. And that potentially changes the way investors think about what Washington is trying to achieve. As we discussed in my previous video, long-term Treasury yields have been surging. The 30-year yield hit 5.34%, the highest level since 2007. The US Treasury then announced that it would double some of the planned buybacks on older, longer-dated debt from $2 billion to at least $4 billion every time they stepped into the market. That reduces some of the supply investors have to absorb at the long end of the market, and initially it worked. Bond prices rose, yields fell, but that situation didn't last very long. Within a relatively short period, yields started rising again, which tells us that the underlying issue didn't go away. And the underlying issue is very simple. The US needs an enormous amount of money. The national debt has now passed $40 trillion. The federal government continues to run a very large annual deficit. It spends more than it earns. Interest costs are already significantly above $1 trillion, around $1.3 trillion. And every time old debt matures, some of it has to be refinanced at today's much higher interest rates. So Washington has a very strong incentive to prevent long-term borrowing costs from spiraling out of control. And one potential way of doing that is to issue more short-term debt and less long-term debt. Instead of asking investors to lend you money for 20 or 30 years, you borrow money for 3 months or 6 months or a year. That reduces some of the supply pressure at the long end. Long-term bond prices can rise, long-term yields can then fall, and the government gets some relief. That's the theory. But there's an obvious question. What happens when all of that short-term borrowing matures in 3 months or 6 months or 1 year's time? Because you've effectively increased the speed at which you need to refinance your debt. If interest rates subsequently fall, then that might work really well. You refinance at cheaper rates in 3 months or 6 months or 12 months' time. But if interest rates remain high, or inflation remains stubborn, or investors start demanding higher premiums for holding US assets, you've potentially created another problem further down the road. And this is why people are starting to compare what America is doing with something called Operation Twist. The United States has done this sort of thing before. Back in 2011, the Federal Reserve attempted to push long-term borrowing costs down by selling shorter-term securities and buying longer-term bonds. The idea was effectively to change the shape of the yield curve. But what we're seeing today is different. This is not currently a massive Federal Reserve quantitative easing program. The Treasury itself is changing the supply and maturity of government debt in an attempt to influence conditions at the long end of the market. And that brings us to another phrase you might increasingly be hearing: financial repression. Again, it sounds rather complicated, but the basic idea is simple. If a government has an enormous amount of debt, high interest rates can become very painful. So governments have historically found various ways of keeping the interest rate they pay below the level that otherwise might exist in a completely unrestricted market. Sometimes that happens through central bank bond purchases, sometimes through regulation or very low official interest rates, or changing the type of debt being issued, and sometimes by allowing inflation to run above the interest rate being paid to investors. And that last point is where we get back to debasement. So let's finally explain what that word means. Historically, debasement was very literal. Imagine you had a silver coin. The government could reduce the amount of silver inside that coin while continuing to tell everybody that it has the same face value. You still had one coin, it still had the same number printed on it, but there was less valuable metal inside it. The currency had basically been debased. Obviously, modern dollars don't contain any gold or silver, so today we use the word in a slightly different way. Modern debasement generally means reducing the purchasing power or value of money over time. And inflation is one of the easiest ways to understand how that works. Imagine you lend the government $100 today. 10 years later, the government gives you back your $100. Now, technically, you've been repaid in full. You've still got $100 for the $100 you invested. But if prices have doubled during the last 10 years, that $100 buys half as much as it did 10 years ago. You got your money back, but the real value of the money you received has fallen dramatically. And this becomes extremely attractive from the perspective of a heavily indebted government, because governments don't actually need to pay debt back in today's purchasing power. They simply need to repay the number of dollars that they promised. So if you owe 40 trillion, one way of making that enormous number more manageable is to increase the size of your economy. Another is to reduce your spending. Another is to increase taxes. But another is to allow the value of each dollar to gradually decline. That's the debasement argument. And importantly, this doesn't require hyperinflation. It doesn't require the dollar to collapse. If you can maintain inflation at, say, 3 or 4% for a prolonged period while keeping the average interest rate on government debt below that level, the real value of the debt gradually falls. The saver loses purchasing power and the borrower benefits. And in this case, the borrower is the United States government. Now, this is not some obscure theoretical idea. Versions of this have happened before. Following World War II, government debt levels were extremely high across much of the developed world. Countries, including the United States, managed those enormous debt burdens partly through strong growth, but also through inflation and periods in which interest rates were held below inflation. Over time, the real burden of the debt declined. So the concern today is not that somebody in Washington has announced we're going to debase the dollar. Nobody's going to do that. The concern is that the incentives are starting to point in that direction. You've got an enormous amount of debt, enormous interest costs, rising long-term yields, and we've now got intervention designed to bring those yields down. If investors decide that the returns available on US bonds no longer compensate them for inflation and fiscal risk, they have other choices. And that's where gold becomes interesting. Following the Treasury announcement, gold jumped by more than 3%. It subsequently moved to its highest level for around 3 months. Why? Because gold is traditionally viewed as a store of value. It doesn't depend on the promise of a government. Nobody can print more gold because they need to finance a deficit. And something similar is increasingly being said about Bitcoin. Bitcoin had an extremely strong week as well. Now, I'm not saying that everybody who bought gold and Bitcoin was suddenly making a giant bet against the US government. Markets aren't quite that simple, but the combination is interesting. Bond yields are under pressure. Government has intervened. The dollar went down. Gold went up, as did Bitcoin. And this is exactly where the phrase debasement trade has suddenly become much more prominent. Investors are effectively looking for assets that might protect them if traditional government currencies lose purchasing power. Now let's bring Japan into the equation, because Japan provides a fascinating warning about the potential trade-off. For years, Japan had incredibly low interest rates. Its central bank bought an enormous amount of Japanese government debt. At various times, it actually controlled government bond yields through a policy known as yield curve control. And the Bank of Japan became an enormous player in its domestic bond market. That helped Japan manage its extraordinarily high government debt burden, but there was another consequence. When interest rates rose sharply in America and elsewhere, while Japanese rates remained extremely low, holding yen became increasingly unattractive. Investors borrowed cheaply in yen and moved money into high-yielding currencies and assets elsewhere. The yen then weakened dramatically, and eventually it became such a problem that Japan had to intervene in the currency market. And recently something extremely unusual happened. The USA became involved as well. America and Japan acted jointly to support the Japanese yen, the first coordinated intervention of this type between the two countries since 2011, so 15 years. That tells you how seriously the weakness of the Japanese currency was being taken. And this is why some people are looking at what's happening in America and asking whether there's a lesson here. Again, I'm not saying that the US is exactly the same as Japan. There are some very big differences. But the basic economic trade-off is worth understanding. If you suppress bond yields while other risks continue rising, you potentially reduce the attractiveness of holding that currency. And eventually, the currency can become the pressure valve. In Japan's case, the yen weakened enormously. In America's case, we're nowhere near close to that level. But if the United States increasingly starts managing the bond market because it can't tolerate higher borrowing costs, investors may begin asking whether the dollar is ultimately going to absorb part of the adjustment. There is another important difference between the US and Japan. The dollar is the world's dominant reserve currency. That gives the US an enormous advantage that Japan never had. Governments around the world need dollars, as do banks and companies. International trade is heavily conducted in dollars. Commodity prices are usually pitched in dollars, and central banks hold enormous quantities of US dollars for their asset bases. That creates structural demand for US Treasuries, and it allows America to borrow on a scale that almost no other country could contemplate. People have been predicting the death of the US dollar for a long time, and they've been consistently wrong. There isn't many alternative assets like it. The euro doesn't have a single unified government bond market, so it isn't really comparable. China maintains capital controls, so the Chinese yuan isn't really the same as the dollar. The Japanese yen obviously has many problems. Gold isn't a practical currency for modern global commerce, and Bitcoin, well, some people are arguing that it could be, but I think a lot of people are still holding their decision on whether or not Bitcoin is a realistic alternative. So this isn't a video predicting the end of the US dollar, but there is an important distinction between losing reserve currency status and gradually losing some of the extraordinary advantage that status provides. The US doesn't need the entire world to abandon the dollar for this to become an expensive situation. If international investors simply become slightly less enthusiastic about buying treasuries, they may demand higher yields, and higher yields dramatically increase the cost of servicing $40 trillion of debt. Which brings us right back to the dilemma. Does the US allow yields to rise and America's interest bill becomes increasingly painful? Does it intervene to suppress yields and you risk putting downward pressure on your currency? Do you allow inflation to remain higher and you reduce the real value of the debt but also reduce the purchasing power of the dollar? There's no completely painless solution here for the US, and I think that's the important point. Something ultimately bears the cost. It could be taxpayers through higher taxes, it could be recipients of government spending through cuts, it could be investors through lower real returns, or it could be holders of dollars through reduced purchasing power. And that's what makes this current situation so interesting. We're not yet witnessing an enormous dollar crisis or hyperinflation or the end of the Treasury market in the US, but we may be starting to see a shift in the way investors think about the relationship between America's debt, America's bond markets, and America's currency. Until now, most of the attention had been focused on bond yields, but if Washington becomes increasingly determined to stop those yields rising, the dollar may become the more important thing to watch, because markets always find a price. If one price is prevented from adjusting, another one often moves instead. And perhaps that's the most important lesson from Japan. Japan spent years controlling borrowing costs. Eventually, enormous pressure appeared on its currency. As I've said, America isn't Japan, but with more than $40 trillion of government debt, the United States is now facing some of the same uncomfortable mathematics. And I think that's why this discussion about dollar debasement is going to become increasingly important. Not because the dollar is about to become worthless, but because the real question is not simply how many dollars America owes, it's what those dollars will actually be worth when the debt is eventually repaid. And if investors start seeing serious questions, then the story we've been watching in the USA bond market could become a much bigger story about the US dollar itself. So hopefully you've enjoyed today's video, you found it useful, informative, and most importantly, thought-provoking, trying to get you thinking in different ways. If you've liked what I've said, or maybe you didn't like it but you thought it was interesting, then please give me a thumbs up for this video. Please subscribe to the channel if you haven't done so already, that's really important to me. And if you have the option, if you can see that hype button, the funny little symbol alongside from the thumbs up, please hit that because it will help promote this video to more people. Thank you so much for watching this video all the way through to the end, and thank you for your support generally. Also, if you've bought me a coffee or sent me a YouTube super thanks, thank you for that, really do appreciate it. And if you've signed up as a long-term supporter, either through YouTube membership or Patreon, thank you. That is the thing that really keeps me focused and motivated and making as many videos as I can. Really do appreciate your support. If you're looking for something to put a smile on your face, unfortunately, I can't show you the usual sort of videos that I was sharing with you because of YouTube restrictions, but I have actually made some videos on jokes recently. I think you're going to like them. Check out one of those. It will definitely put a smile on your face.